Well, thank you very much, Betty, and thank you all for coming today. It's a great honor to be here. It's my first time in your building. I must say that I'm a native New Yorker, born and raised in the Bronx. Think I know everything about the subway system. I could go anywhere in my sleep in New York. Well, this morning, I must have been asleep because I took the train. I live in the West Village. And I took the train downtown, and I said, okay, I know where it is. I looked on the map before. So I just started walking north of Chambers Street. And after about 5 blocks, I realized, my goodness, I'm not finding Murray Street after all, where I thought it was. So I turned around and asked the lady. She said, oh no, it's south of Chambers. And so I finally made it, and I'm sorry I missed the first talk, indeed, because it's a topic that's near and dear to my heart, that of rating agencies. And you all know that rating agencies are under fire, that they are going to be reorganized, etc. And there's going to be big changes in that area, but unfortunately, the business model is not going to be changed, and we're probably not going to find all that much different, in fact, of their impact, which is considerable. I'm going to talk a little bit about ratings and rating agencies, but not much today. I would like to thank Betty. Where are you, Betty? She does so many jobs. She takes pictures and organizes conferences in the journals. You do a terrific job for the FMA. Jack Rader and I have been around a long time. Many of you in the audience are as well. So it's a great privilege to be here today and to speak at this first, hopefully, annual conference that you hold for the journal. I sometimes do miss, when I give a speech, I sometimes miss the speech altogether, so this is good. At least I got here before the end. I recall the time I was in the south of France giving a speech in Nice, and my wife asked me, is there time to go to the fish market before your speech? And I said, yes, but I have to be back by 10:30. So she said, fine, and I said, fine. So we went to the fish market, and about 8:30, my cell phone went off, and on the other side of the cell phone was my driver. Whenever I do work in the north of Italy and the south of France, and it's related to an organization called the Centrale di Bilanci, which you heard from Betty that I do some advisory work on. I always have the same driver, and his name is Mario. And Mario was on the line, and he said, Professore, where are you? And I said, I'm at the fish market. He said, no, Professore, you should be at the hotel. There are 1,000 people waiting for you to speak. I said, no, Mario, it's impossible. I'm speaking at 10:30. He said, no, Professore, listen, I'm there, and there are 1,000 people, and they're waiting for you. I said, it's impossible to make it in time. I'm wearing shorts. It's very warm. I have to go back and change. He said, well, may I ask you what you're speaking about today? So I said, I'm talking about managing credit risk. He said, oh, Professore, I've heard you give that speech so many times. Maybe today I can give it for you. So I said, no, Mario, you have to understand, it's a highly sophisticated, scholarly audience. Lots of equations in the speech and the model that I'm going to talk about. He said, well, you are there, I'm here. Do they know what you look like? And I said, I don't think so. It's a new group. I haven't spoke to them before. He said, well, shall we give it a go? I said, well, if you think you can pull this off, I'll get there as soon as I can and stand in the back, and we'll reverse the roles today, right? And I'll be your driver and you'll be the professor. So sure enough, I get there, and he's doing a fantastic job. I mean, he's got all the timing down perfectly. He's got the the equations exactly correct. And he's doing a fantastic job. Great, slight accent on the English and the like, but he's doing a great job. And he finishes, and he gets this huge round of applause, probably more than I've ever received. And so I'm feeling really good. He's looking really good. And then the moderator says, well, Professor Altman, is there time for 1 or 2 questions? Now I see Mario beginning to sweat a little bit. He's a little uneasy, and I'm very uneasy in the back. And sure enough, so he says yes, 1 or 2 perhaps. And sure enough, this tall, distinguished scholar in the back of the room asked this incredibly complex difficult question. And now I see Mario really beginning to sweat and looking very, very uneasy. And I'm really feeling terrible. And but this Mario is a very clever fellow. And he said, you know, sir, that question is really so simple. Even my chauffeur in the back of the room can answer. So I hope there's somebody wandering around out there that can handle that questions. Actually, I will say around for lunch, and if you corner me, especially if you had got a little glass of red wine to go along with it, I'll tell you what part of that story is true. And let me just give you a little quantitative evidence that 2/3 of the story is true. And if we don't have a chance to talk, you can perhaps figure out what's the third that's not true. But indeed, some of it was actually accurate. And Mario does exist. I can tell you, I give a lot of speeches in Europe, and oftentimes, a year or two later, I meet the same person in the audience, and they forget completely what I said in my speech, but they ask, how's Mario doing? He's a very famous guy in Europe these days. Well, I'm going to talk about a much more serious subject, and that is current conditions and outlook for not only the corporate market, but an area that I've become much more interested in, and is the new thread of our research in the area of credit markets, and that's sovereign risk, and particularly what's going on today in Europe. And I'm going to talk not only about what has happened and what could happen and what I think will happen, but also the impact if it happens. And I'm talking about the survival of the euro itself on capital markets globally. So we're talking here about something that's really, really serious. And indeed, what's going on in the European Union and the World Bank, and particularly the IMF today, and a lot's going on at the IMF. Incidentally, I just heard, got an email, I don't know if any of you read about this, but a name that's being bandied around to be the new president of the IMF. I shared an office with him for 4 or 5 years at NYU when we both were junior rookie assistant professors. And this is somebody actually from South Korea, although probably the front runner is Christine Lagarde, who I'm speaking with actually in 2 weeks in London at a conference that we're holding. And if she does get the IMF presidency, I don't think she'll show up. She'll probably be so busy doing other things. But keep your eyes open. Who becomes the new president of the IMF? It's an incredibly important position normally, but in these days, a lot more. I'm going to motivate my talk today by showing you maybe a graph that some of you are quite familiar with, but it's an incredible story of what we've all lived through for the last 4 years. From 2007 to today, about 4 years. If you go back to June 12, 2007, down here, this is a graph showing the risk premium between high-yield bonds and 10-year U.S. Treasuries. It's a benchmark that we use, although it's not the only benchmark you can use for the, quote, risk-free rate. And we know today there's no such thing as a risk-free rate anywhere in the world, including the United States. But we've always had some sort of benchmark that you needed to use to capture the required risk premium that investors hold for various asset classes. In this case, U.S. high-yield bonds. So on June 12, 2007, the rate was 260 basis points, or the spread, or 2.6%. 2.6% was the lowest in the history of the high-yield market, going back to 1977. Now, 260 basis points as a spread also shows a benign credit cycle and a very low required rate of return as a premium. But if you had looked carefully at the credit quality of the companies that comprise the high-yield bond index in 2007, you may have concluded, as I did, that almost never had we seen a more risky market from a standpoint of fundamentals. So everything we teach in finance, and some of you out there who practice in the financial markets, was completely upside down from what should be the case. Investors were getting incredibly low returns for very high risk. And yet, the music kept playing. And so this was a tip-off, and I predicted there would be a credit meltdown and wrote several articles in 2006 and 07 that the bubble in credit markets was about to burst, but I was wrong. It was not because of the corporate credit market getting so out of line. It was, of course, the mortgage-backed securities and the structured financial instruments that imploded that led to the worldwide crisis and almost changed permanently, rather than temporarily, the nature of risk return in capital markets. Well, that spread then went from 260 throughout the summer of 07 as we began to get uneasy about the mortgage-backed security markets, continued to rise until March 08. And in March 08, we had Bear Stearns debacle. Then the markets calmed down. And then the big spike occurred, as you all know, in September 15, 2008, when Lehman Brothers filed for bankruptcy. Now, there's been a lot of discussion about whether or not Lehman should have gone bankrupt or whether or not it was, like the others, too big to fail. It turned out it was too complex to fail, at least from the standpoint of the markets. And its impact internationally was far greater than the Federal Reserve and the Treasury Department and others felt in that fateful weekend when Merrill Lynch was bailed out. ING was rescued, but Lehman was not. And maybe any one of them would have prompted what happened was an incredible spike in spread from about 800 to 1700, and 2 months later in December, 3 months later, it reached 2,050 basis points approximately. To give you an idea how high 2,050 basis points is as a spread between risky debt and risk-free debt, the all-time high prior to this period was 1,100 basis points in 1991. So we were 1,000 basis points, or 10%, above the all-time high in terms of risk premium. And the liquidity in the market dried up completely. There was an incredible flight to quality. Banks wouldn't lend to banks. Corporations couldn't borrow. Short-term debt couldn't be rolled over. And in this period of time, there was a tremendous fear that the markets would implode and there wouldn't be business as usual going forward, at least not for a long time. Well, things did recover, thank goodness. I think you can credit maybe 2 or 3 reasons for that recovery. The primary one was the incredible amount of liquidity pumped into the system by the Federal Reserve of the United States, and to some extent by the European central banks, and indeed by China and other countries as well in their own communities. And that was the original quantitative easing of about $2 trillion. Of course, we've had a second one of $600 billion, which may or may not ease up going forward, and we can talk about that as well. But indeed, what happened was, besides this liquidity flowing back into the market, and markets beginning to function a little bit more normally, there was a tremendous reversal in the stock market. And that bred confidence and a feeling that the world wasn't coming to an end, and that in fact it was going to be tremendous opportunities as well, rather than a tremendous debacle going forward. And we know when you have these radical jumps or shifts in financial market performance behavior, you get the performance as well. And notice that spread dropped from about 1,800 in April 09, sorry, 09, dropping all the way, indeed, dropping below the all-time average, which, keep this in mind, the historic average between high-yield bonds and treasuries is about 525 basis points, or 5.25%. And we dropped below there. We reached 442 in April. Then it went up a little bit as Europe became more controversial and the probability of default of several European countries, which is still the case, began to increase. And then it dropped below the average, something like the end of 2010. And today, it's about 410 basis points. And it's been wandering in this area for about 4 or 5 months now. So we're at the stage that we're below the historic average by about 125 basis points. We are about 140 basis points above the all-time low. As I'll show you in a moment, default rates among junk bonds is at an incredibly low level and has been for about 14, 15 months. Interest rates are very low, of course. The Fed is keeping it low. Firms are finding it very attractive to borrow again and again and again. And the credit covenants that normally are part of the credit package are beginning to become less and less stringent. Indeed, give you an incredible statistic. In 2010, the high yield bond market had about $230 billion of new issues. That's 50% more than any other year before. And so far this year, it's running far greater than that. You know, we're probably up to almost 100 billion by the middle of May. So if this keeps up, we will break the all-time record of new bonds issued by risky companies. And now the banks are beginning to get jealous because all the action has been in the bond markets. And so the loan market is beginning to pick up as banks get healthier, begin to pay out dividends, and begin to feel more comfortable putting risk on their balance sheet and having the capital in many cases to absorb the higher reserve capital requirements under Basel II and soon to be Basel III. So we are in a benign credit cycle right now. One would ask the question then, what could go wrong or might go wrong to upset the situation? And that leads to the outline. I've listed here about 6 or 7 uncertainties, or risks really, not uncertainties, risks going forward that I think we need to be concerned with. Some are more important than others. Indeed, the first 2 are the ones where I'm going to spend the rest of my talk on. The real economy and its outlook, and secondly, on the sovereign debt crisis, and particularly what's going on in Europe. We'll talk about the United States as well, if you'd like to. So let's talk about the real economy. If I had asked this question 6 months ago, probably something like let me go back. Let me ask the question, and then we'll see what the reaction would have been 6 months ago, 2 months ago, and today. What's the likelihood that the U.S. economy will have a double-dip recession and go back into a negative growth rate in our economy and having the attendant problems in productivity, unemployment, etc. So if I ask that question of a double-dip recession in the next 12 to 18 months, 6 months ago, most of the audiences that I've spoken to would have said something like 25, 30% probability. If I asked this question about a month, maybe 6 weeks ago, and I did, the response would have been probably less than 10% probability. In other words, the U.S. economy is perking along and doing quite well. What about today? Let me ask you. You all read the newspapers and are concerned about markets, I'm sure, in one way or another, and therefore the economy. How many of you think that the probability of the U.S. economy going into a recession again, and I must tell you, we define a recession in the United States differently than almost everywhere else in the world. It is not, as most people think, 2 quarters in a row of negative GDP that defines a recession. That's a necessary but not sufficient condition. There are 4 or 5 other variables that the NBER looks at in determining whether we are in a recession, and therefore we find out that we're in or out of a recession somewhere between a year and a year and a half after the event. So we found out in August of 2010 that the recession ended in July '09. To give you an example of the lag in the knowledge that we're in a recession or not. But forgetting about that, just think about negative GDP happening again. How many of you think that the probability now, over the next 12 to 18 months, is less than 10% probability of a recession again? Okay, we've got 1, 2, 3, 4, 4 or 5. How many think it's between 10 and 20%? Okay, this looks like a much more robust number. Looks like about a little more than a dozen. How many think it's more than 20%? Okay, same number as though it's less than 10%. Well, this is a pretty optimistic audience, because I've asked that question in the last week or two, a few times. I gave a talk in California 2 days ago, and there was a board meeting we went to yesterday. We canvassed things, and I think the sentiment now is something like 20%, which is up from under 10% a little while ago, as some of the numbers coming out on housing, on unemployment, on the risk of inflation, etc., although that's a very minor risk, is there. But there is a chance of a double dip. I say it's not significant or that high, so let's not consider that as a major risk going forward. But we should understand that if we do go into a recession, like the yellow bars here, that the default rate on high-yield bonds, which is only one indicator of credit quality problems, will escalate in the recession and reach its peak sometime in the middle or the end of the recession, as it has over the last several recessions that we've had. But right now, the default rate is way down here. The last 12-month default rate on high-yield bonds is just about 1%. And indeed, for the first quarter of this year, it was 0.14 of 1%. And indeed, that's continued through May 15th, or whatever, May 20th, where we are today. We keep data on this on an almost daily basis in terms of updating our numbers. So today it's about 0.2 of 1%. If that keeps up for the rest of the year, it's going to come in at under 0.5 of 1%. So you got to go back to 2007 when it was 0.5 of 1%. This is not good news for somebody like me who loves defaults and bankruptcies. I mean, we have to apologize to some people, although this audience probably I don't have to, when I say, you know, we love bankruptcies, because they're data points in our empirical research, and we need that to do our work properly. And I think you may have heard me say this before, but I'll say it again. My wife and I have this tradition of opening up a bottle of fine red wine every time there's a big bankruptcy. And if there's 2 or 3 in a short period of time, we move to the fine champagne. Well, in 2002 and 2001, and again in 2009, we were drunk all the time. It was such a fantastic period. And now the Altman family has a bit of a liquidity crisis right now. There's not much wine flowing, at least not from the bankruptcy events. Maybe we can invent some other areas that we're interested in to celebrate. But all kidding aside, these statistics do vary over time dramatically and change very quickly. Who would have predicted in 2009, when it was almost 12% default rate for the last 12 months, that it would have dropped to 1% in just a little bit more than a year? But it has. And today we're in an incredible benign market. If you look at the bottom of this chart, you'll see that in 2010, there's not many times when I give a speech that I look down to give data. Usually, you know, being a little vertically challenged, I have to look up. But if you look down, $229 billion was raised in the high-yield bond market. And so far in the first quarter, $68.6 billion in just the first quarter. And indeed, through May 13th, which is not on here, it's now close to $100 billion. So $100 billion in 5 months, we're headed to break the record. The market is incredibly liquid. Companies are raising money. And take a look at the so-called bad cohort. That's the B- or lower proportion of high-yield bonds that are issued. During the build-up to the crisis, that ratio of B minus or lower to total high yield was between 33 and 39%. It jumped to 51% in '07, which was the craziest year. And then, of course, dropped dramatically when the crisis hit in '08 and continued 14, 21, 27. And so far in 2011, about 1/3 of all junk bonds that are issued are now issued at the lowest ratings. Now you may argue, and those of you who, let's see, where are you, the lady who did the paper on rating agencies? You here?
I'm right here, yeah.
Yeah, okay. So I don't know if you've heard the argument that maybe the rating agencies have changed their criteria for ratings because they've been criticized, right? They've been criticized for not catching Enron and WorldCom and being slow on sovereign debt defaults, and indeed, generally but they are slow. You know, they're not stupid, they're slow. But they're slow by design. It's part of their policy to be slow. Just think about it. And part of it is a problem with the business model of rating agencies, and part of it is sound business strategy on their part. Who are their customers? Right? Their customers are the companies and the institutions that float the issues. If you ask them, do you like volatility in ratings or do you like stability? What do you think they're going to answer? Stability, of course. So to be slow means more stable ratings. Now, accuracy is important. So right away you look at what was the rating just before, or maybe a year before it defaulted. But you notice the multiple downgrades that occur usually right before default. And that's no accident. That's because now it becomes apparent to everyone that they're going to default, and they don't want to have a rating that's investment grade or near it prior to default. But the question is, if you get criticized for being slow or inaccurate, do you change your criteria for rating going forward? Which could explain why, not so much here, but here we're seeing a higher proportion of low credit companies, even in this benign credit cycle when profits are up, corporate balance sheets look much better, but still, these really shaky companies are able to refinance and get financing in this benign period, just like they could here. And so while I'm not trying to sound the alarm bell that we're in a situation very similar to 2007 in all respects, this is beginning to look like 2007 again in terms of credit quality, covenants, etc. in the corporate bond and loan market. And indeed, leverage is creeping back into the system. Maybe creeping is not the word, because if you combine the private debt and the public debt of the US government and municipalities, there's probably far too much debt in the system. And so one of the big warning signals, nightmares out there is not to be able to refinance the debt if there is a major shock to the system. Right now, the markets seem to be quite resilient to what's going on in Europe, what went on in Japan, and so on, and the markets continue to accept just about any type of new financing, especially if a good story accompanies it. But let's go on to the second area, which the one, in my opinion, is the most interesting and the one that's most fraught with risk. And if Greece defaults, which I'm convinced they will, I don't know when, whether it's before or after 2013, which is a benchmark year that has been identified by the European Union, then the markets will react and react dramatically. Not just the sovereign markets, incidentally. But let's step back a second and talk about the crisis in Europe right now. What led to it, where we are now, and what's likely to happen going forward. Incidentally, this is a new area for me. And therefore, you could say, well, why are you qualified to comment on a sovereign debt market that's been around for ages, indeed for almost for centuries, when you've only begun to study this market? What qualifies you to do it? Well, the answer is, I think, that I've looked at failure prediction models and default prediction models for about 100 years now. Well, yeah. Sometimes when people like Betty was kind enough to recall that luncheon, which I didn't recall, thank you, but and they see that I'm on the program, they say, "Is he still alive?" I studied his work, 40 years ago, which is true. Some of the models we built are more than 40 years old now, and they're still being used, maybe used more than ever before, which is quite surprising. Bob Haldeman's in the audience. He and I built a model called Zeta in 1977, and it was, we might call it Son of Z. And I'm going to talk to you today about grandson of Z, something called Z metrics that we built last year. Back to the sovereign debt crisis. Well, you remember the triggering event. In early 2009, late 2008, Greece revealed that in fact their deficit to GDP was not 6%, but it was like 12 or 13%. That the numbers that have been coming out of the central bank and the government of Greece was incorrect. And of course, this was a revelation on the part of the new government blaming the old government for misleading the public. And maybe blaming some investment bankers who advise them on how to account for certain aggregate statistics. And so we were all of a sudden told that one of the peripheral European countries, namely Greece, was far, far above this arbitrary benchmark of 3% deficit to GDP that the European Union instituted several decades ago when the euro first was floated. And we all began to wonder, well, is it just Greece or is it other countries that were also fabricating their data because of this bogey that was out there, this 3%, and therefore could we trust any of the data that we were seeing? The second sort of thing that jumped out was the fact that all the models that I've been reading about when I started doing this research about a year ago, and have been thinking about for many, many years, was of the following nature. Almost all the models, including multivariate models like we built for corporates, as well as standard banking risk models, utilize macroeconomic data in analyzing the health of the sovereign. Debt to GDP, deficits to GDP, growth rates in GDP, productivity, unemployment, trade deficits, and the like. All the banking models out there, all the sovereign risk models, whether they be statistical or qualitative, look at aggregate quantitative data about countries' performance. And then they try to say something about the likelihood of paying back that debt. And indeed, we have bond ratings just like for sovereigns, just like we have it for corporates. The AAA down to the CCC countries. And investment grade seems to be very common, and indeed, in the beginning, and I don't have the slides with me now, but you can easily get them yourself, or I can send them to you, of what the rating agencies were saying back in 2009, 2008, 9, and 10, and all the suspect characters were AA, or AA minus, or A plus, including Greece, Portugal, Ireland, Spain, Italy. They all were high investment grade companies, investment grade countries. And but then we learned about Greece. And I began to think about a year ago, after some of this revelation came up, what's wrong with the models? Why were the models all saying that these were very good countries in terms of risk? And they were all part of the euro, and therefore they were probably going to be bailed out if they got into trouble, which of course seems to be the case up to now. And I realized one thing that was missing. And it reverts back to an experience I had in 1996. But rather than tell you that experience, I'm going to ask you a question. How many of you remember the Southeast Asian and East Asian crisis of 1997 and 8? Good. And some of you actually might have been in the markets then. Second, here's the question. Which country of all of Asia would you have predicted to have the highest likelihood of default at the end of 1996 prior to any revelation of the crisis? Incidentally, do you remember where the crisis started? What was the first country? Thailand. And then it spread east, remember? Now, let me give you a hint of what I'm driving at, and then I'd like your answer. Instead of looking at the traditional measures of sovereign performance that I just mentioned before, let's concentrate on the health of the private sector in each country. And so here's the question again, rephrased a little bit. What country in all of Asia would you think had the most vulnerable, higher risk private sector of any Asian country prior to the crisis? What country would you choose? This is an exam, a quiz, but I'm not going to grade it, so don't worry about it. What country? You know, it doesn't matter if you're wrong. Indonesia. They were third from the bottom. David?
I would choose Korea.
Son of a gun. You know, there's always one in the crowd that, you know, gets the right answer quickly instead of giving me a chance to string this thing along. But okay.
They had no international reserves. That's why.
Well, no, that's part of it. They also had the lowest average Z-score of any private sector country. If you aggregate the listed companies, and those are the ones we can get data on, their average Z-score was the lowest of every Asian country. And yet, they've been growing at, David, how much were they growing at each year?
It was double digits.
Double digits for a decade. They were one of the Asian tigers with the biggest teeth. What was their rating? Anybody know what their rating was in December 96? Double A minus. 6 months later, double B minus. And David, what did they have to get to save them?
IMF money.
IMF money of 50 billion US dollars. Yeah, $50 billion. Incidentally, the same amount that General Motors got when they went bankrupt. It's kind of interesting. $50 billion. Mr. Gladwell writes in his book on outliers that you must have a minimum of 10,000 hours working in your field before you qualify for success. He has a lot of statistics to go along with it. Well, I'm going to say you need $50 billion minimum from some sort of rescue to save you, at a minimum. And of course, what did Greece have now? Greece has 90 billion and is likely to get another 50 billion or so, 30 to 50 billion in the next couple of weeks. The point I want to make is that South Korea had very little reserves relative to their necessity to bail out the banks. 50 billion, that was how much they had in their reserves at the time. And 2 or 3 banks, if they went under, would use up those reserves. So yes, a combination of macro and macro data. Reserves coming from macro, micro, the vulnerability of the private sector, both corporates and banks. So with that as a background, here's the very simple idea that we've written about and just published an article on. Our thesis is very simple. You can tell the health of a sovereign by the health of the private sector. Because when you think about it, who pays, theoretically anyway, most of the taxes for a country? in addition to the consumer? Companies. Now, I said theoretically, one of the big problems in Greece is the ability to collect the taxes, of course, and it's not just Greece. But profitable companies pay more taxes than unprofitable companies. And companies that go bankrupt obviously don't pay any taxes. Second, who hires the workers? Well, it's companies or the government. But the government is now forced from austerity programs to cut back on their programs. Just as the municipalities are cutting back in the United States. I don't see much cutting back yet in the federal government, but that's coming. In fact, one of the big problems, and this is our preview of coming attractions, going forward is the fact that the Republicans are threatening very seriously not to raise the debt limit without massive cuts, almost on a one-to-one basis, if I read the newspapers correctly. But getting back to sovereign risk. So the very simple idea is, let's try to quantify the probability of default of the private sector in each country and use that as a metric for the probability of default of the sovereign. That's the idea. So here's some data that might be of interest to you. Somebody please answer your Skype so we can get that off the screen. What we've done is looked at 11 European countries and the United States. We've looked at, first, the non-financial sector. So these are listed non-financial companies in all these countries, and some of them have a lot, and several of them, like Ireland and Portugal, have relatively very few listed companies. We've then taken this new model that we just built in partnership with a risk consulting firm called Risk Metrics, which is now part of MSCI, and we've called the new model Z-Metrics. And Z-Metrics combines, it's like a hybrid model. It combines three attributes of a company and its environment. The first is the type of traditional financial statement data that I've used and Bob has used and others have used before in our Z, Zeta, and there are a number of other models that are out there using traditional financial statement analysis on the company, perhaps throwing in some market value variables as well. Indeed, that's the second ingredient, so-called Merton or KMV type variables, market equity to liabilities, volatility, and so on. And third, macroeconomic phenomena, but not a lot of it. We use the risk premium on high-yield bonds and unemployment in our model. So it's a combination of micro, market value, and macro data, all churned together into this new Z-Metrics model. It is a logistical regression, and the result of it, and I have a presentation on it, but that's not the main focus for my talk today, the result of it is a 1-year and a 5-year probability of default of the company. Now, keep in mind, we're going to aggregate the companies to get the risk of the sovereign. That's the idea. And that's what we've done for year-end 08, 09, and year-end 2010. So those are the three data points that we had. When we wrote the article, we only had 8 and 9. We just recently recalculated or calculated 10. So if you go back to 2008 year-end, this was before the crisis was really understood at all. Maybe there was some rumblings. I think Standard & Poor's had a publication done in early 2009 warning that if countries like Greece had big problems with their deficit to GDP going forward and didn't correct it, that they were subject to possible downgrades. Nobody talked about defaults then very much at all. So if you look at this hierarchy, not surprisingly you find the, incidentally, here's where we did something arbitrary. And we didn't have to do it, but we had to choose something. We chose the median, the 50th percentile probability of default company as the metric to look at. We could have chosen the 75th percentile, the 90th percentile probability of default for 5 years as our metric. We chose the 5-year horizon to compare it with the CDS market, because the most liquid contract for the credit default swaps is, of course, the 5-year market. And we'll also transform then the credit score that we get from our Z-metrics model to a PD directly using the logistical model. There are other ways of getting a PD, mainly going from a score to a rating equivalent and then looking up statistics either from the rating agencies or our own data when we built our mortality model to come up with a PD. So these are median PDs, and so we have Portugal and Greece at around 12%. You have Italy, third, at 10.5. Spain, where's Ireland? Ireland, see, these are not exactly in the right order in terms of the hierarchy. The 2010 is the basis for my hierarchy. But the usual suspects have the highest PDs. So we knew that by looking at it that their private sector was weak. And indeed, some of the others were not great, but they were relatively small for 5 years. And incidentally, notice that most, except for 1 and 2, most people, maybe only one, most median PDs actually improved in 2009 versus 08. And again, in 2010 versus 09. Why do you think that the average company in these countries, including the United States, actually look more healthy today than 2 years ago, even though the crisis is now 2 or 3 years in the running? Stock market. It's a major variable in the model. The market value of equity to total liabilities. And the stock market in the world have done very well since the beginning of 09, throughout all of 09 and into 2010. And therefore, these PDs are lower, except for Greece. Even with a slightly higher stock market in 09 versus 08, I have some data on it, I think, later on. Yeah. This shows you the increase in the average company on the various stock markets in Europe and the United States. Most went up by double digits, 20, 30%, except for Greece, only 5.5%. And that is a factor in the model. Okay, going back here then. Today, we have Greece having the highest probability of default of the private sector, consistent with the CDS spreads. If you go on the right-hand corner, get this statistic. It's absolutely amazing. The implied probability of default from the CDS spread on Greece today is 70.66% over the next 5 years. There's an equation in the footnote here that converts the spread to a PD, probability of default, assuming a recovery of 40%. Incidentally, if Greece defaults, we predict about a 50 to 60% haircut that the bondholders will have to take. So in other words, the LGD, loss given default, on a Greek default will be about 50 to 60%. That's what the prediction is. Do you remember what it was for Argentina when they defaulted in 2000? Well, the price of Argentinian debt at the time of default was 28 cents on the dollar. So 72% was the LGD. It's not going to be as bad, but it's not going to be fun either. One reason why, and you probably have read this too, that the European Union is propping up Greece is to save the hit to their big banks in Europe. And indeed, the European Central Bank is now the biggest holder of Greek debt, Portuguese debt, etc. And of course, they're going to have to take the hit also, unless there's a somewhat differentiation between local debt and foreign holders, and especially those terrible, terrible hedge funds that have bought this stuff at 30 cents on the dollar or 40 cents on the dollar. God forbid that they shouldn't take a haircut that's bigger. But you know, there's going to be that kind of talk. Even though everyone in Europe now, the politicians in particular, are saying it will never happen. Don't believe it. It could very well happen, and happen soon. Then there's a question between a soft default and a hard default. Reprofiling, I think, is the, I don't know where they came up with that one from, but that's the word that they're using as a possible remedy to the situation. This shows now, we're just beginning to, I know I've got about 5 or 10 minutes left, so let me try to finish up this main piece and talk about what I think is going to happen. One of the soft spots in this model here is the fact that it's only non-financial firms that we're looking at. We do not include data on banks. And we know that banks are the biggest problem in Ireland. Banks are a major problem in Greece. Banks are very important in many countries, including the UK. And so the UK numbers, perhaps, are quite surprising. That's over here. Oh, the UK numbers here, if you follow that across, relatively low probabilities of default. And let's see, the UK here. So, for example, today's probability of default of the median firm for the UK is 4.3%. The implied PD from the CDS market is 6.5%. 4.7%. Oh, we're right on target. 4.7 and 4.3. Incidentally, we're very close in many cases, except the extremes. Greece, 70.6. Portugal, 41. Ireland, 41. So the markets know certain things that our model doesn't know. But don't forget, one of the attributes of and Bruce Tuckman probably knows this very well from his talk this morning, and I know his work, CDS market is also very volatile. Much more volatile than fundamental models, much more volatile than the underlying markets, the bonds, etc. And they move up and down based on all sorts of information. And then you say new information is good, but if the information is not good, then the reaction in the markets is also not good. Okay, this is the 5-year implied probability of default of Greece, 70%. Notice what happened in 2009. That's this. It actually went down. Why? Because of the rescue fund from Europe. Right? If you're protected, then why do you need insurance? But why is it 70% now? Because they're still protected. It's because the markets don't believe that that protection is going to be there. And they're right. And here's